A bullish market condition refers to an environment in financial markets where asset prices are rising or are expected to rise over time. This upward trend is driven by optimism, investor confidence, and strong market sentiment. Bull markets are typically fueled by favorable economic conditions, such as robust GDP growth, low unemployment rates, rising corporate earnings, and supportive monetary policies like low interest rates or quantitative easing. In a bullish market, demand for assets often outpaces supply, leading to steady price increases. Investors in a bull market are generally motivated by the expectation of future gains, which encourages them to buy and hold assets, driving prices even higher. The stock market during a bull phase often sees broad-based gains, with indices like the S&P 500 or Dow Jones Industrial Average climbing steadily. Sectors that perform well in a bullish market are often those tied to economic growth, such as technology, consumer discretionary, and industrials. Traders use strategies like trend following and buy and hold to capitalize on the momentum of rising prices. Conversely, a bearish market condition describes a scenario where asset prices are declining or are anticipated to drop further. Bear markets reflect widespread pessimism, fear, and uncertainty among investors, often triggered by adverse economic factors such as recessions, declining corporate profits, geopolitical tensions, or tightening monetary policies like interest rate hikes. A typical indicator of a bear market in stocks is a sustained decline of 20% or more from recent highs. In such conditions, the supply of assets surpasses demand, leading to prolonged price declines. Bearish markets are often characterized by increased volatility, as traders react to negative news and economic indicators. Unlike bullish markets, where confidence drives upward trends, bearish markets see a retreat from riskier investments as investors seek safety in cash, bonds, or gold. Short selling and defensive strategies become popular in these times as they allow traders to profit from declining prices or protect their portfolios against losses. Understanding bullish and bearish market conditions is essential for successful trading and investing. Each market phase presents unique opportunities and challenges, requiring investors to adapt their strategies accordingly. For example, in a bullish market, traders might focus on growth-oriented stocks and leverage opportunities, while in a bearish market, they may shift to defensive assets or use hedging strategies like options to minimize risk. Recognizing the transition between these two phases is equally critical, as it allows investors to position themselves advantageously. Key indicators of market shifts include changes in economic data, market momentum, trading volume, and geopolitical developments. By staying attuned to these signals, traders can navigate the complexities of market cycles, seizing opportunities in bullish markets and mitigating risks during bearish periods.